All right, I'm Michael Hartzman along with Dominic Tavella, and we're back with our guest, Greg Serbe, who's a senior managing director of the Lebenthal Ultra Short Tax-Free Bond Fund and also Lebenthal's suite of SMAs. And Greg, I mentioned briefly as we were heading into the break that you're kind of like a first cousin to us because we both use the Lebenthal name. Why don't you spend a minute just explaining your legacy with Lebenthal?
Oh, absolutely glad to. I joined Lebenthal way back and was in the original firm, managed the mutual funds that they had, managed the separately managed accounts, some of whom I'm sure everybody out there still remembers, God bless him, Jim Lebenthal's ads. The firm was then acquired by an insurance company, and subsequently they had to restart the company. So I came back into the new company. And that's why, to me, this is like old home week, because I was part of the original Lebenthal and the other incantations of it. Still doing munis, still doing what I love. I started doing them many, many, many years ago. And to me, it's the most fascinating market. Um, Even though, yes, it's more exciting to talk at a cocktail party about buying XYZ stock and flipping it. People forget to tell you about the ABC stock that they bought high and sold low, but that's a different issue.
It's another, yeah, a story for another night. So Dom and I have a ton of questions, but
Great.
if I can, let me start with that yin yang that if you heard me mention right into the break
Mhm.
about the push pull between states are hurting, interest rates are low. When interest rates go up, bonds get clobbered. Versus we have a Democrat in the White House, a Democratic Congress and Senate. Therefore, taxes are going to go up. So, where does a muni manager go? How does a muni manager, negotiate that landmine?
Well, to me, it's not a landmine. To me, it's an opportunity.
Hmm.
And, yes, the municipalities have had tough times. But let's go back to 2008, 9, 10. They laid off people. Default rate on an investment grade muni over time is less than 1/2 of 1%.
Hmm.
The states do what they have to do. They pull back. So they somehow managed to get through this. And to your point, both about are we going to see perhaps more demand because of tax increases? Probably. That's all good for munis. In the meantime, what do you do? How do you deal with this? You don't put all your eggs in the one basket. Instead, you have some bonds that are coming due shorter, a little bit further out, a little further out, so that if rates do go up, you have maturities. So you're going to be reaccessing the market at the new higher rates. If they don't, you're just going to continue to go along, still avoiding taxes. And I do believe, again, no guarantees, but taxes will go up. They have to, for no other reason than just the massive deficits that the government under both presidents, the current one as well as the prior one, ran. So, yeah, but munis have a beautiful track record in that universe.
Hey,
Thank you.
Greg, so we're thinking demand is going to go up, right? Because of all the reasons particularly higher tax rates. But talk to me about issuance. Has the issuance kept up? New bonds coming to the market, has that kept up with demand?
Lately, we've seen actually a shortage of bonds. Some of that's typically seasonal. Uh, December 1, January 1, heavy, heavy, heavy maturities, interest rate payments flip down to July, June, July, the same thing. Um, and a lot of municipalities just sort of sit back and wait. Also, because of all the things that are going on, their attention has been elsewhere. Supply will build up, and especially, in my opinion, because infrastructure, the needs are so dramatic that how do you finance it? And especially when you're just not getting tax revenues in hand over fist, you borrow. The Trans Hudson Tunnel, that's going to cost New Jersey and New York billions, even though they're going to get a lot of federal aid. It's going to cost a lot of money. That's the kind of infrastructural investments which are ribra. They're good. They're solid. So it'll be coming, and there'll be good bonds coming.
Greg, right here in our hometown here in New York, has the death of New York City been greatly exaggerated?
To answer that question, yes and no. It's very sad to walk down the street and see restaurants that are closed. But on the other hand, they're also now built these little shelters out in the bus lanes.
Mm-hmm.
They're trying, they're striving. Rents are down, everything's down, but it's still New York City. It is still, Broadway will be coming back. I just got in the email today, literally from the Giants. Hey, time to let us know how you want to buy your season tickets this year. So life is going to come back, and with it, economics, and definitely that I I feel very strongly about that. And New York City is in a good position, notwithstanding, as is the state, notwithstanding the headlines and the headline rescue. So I'm comfortable about that.
So one of the things we've really been focused on are revenue bonds. So you mentioned the possible tunnel that to be built. So you think about people going over the bridges and the tunnels, and every time, well, in the old days, the thing would go up and down, right? And it was cha-ching, cha-ching. Every time it went up and down, the city made money. So today it's all electronic, but we do expect that traffic, as the economy opens up, which we talked about in our earlier segment, that level of activity is going to increase, and therefore revenue should increase, right, Greg?
Oh, absolutely, absolutely. And that brings up sort of some of the opportunities out there, because with all the concerns, and this has been a terrible year, we can't even begin to approach sadness of over 450,000 people gone because of this. That's put a lot of pressure on, sort of like you're saying, the outdoor activities, schools working virtually. So spreads have widened. Right now, I'm kind of interested in the fact that just out in your neck of the woods, there's some credits that we've owned before that were tighter relative to where the best AAAs were, or the Adelphis, in schools like that. They've widened out, but they're not going to go away. It's an opportunity that later on, as everything starts coming back and getting better and better, spread relationship on those securities is going to work. It's going to give us more of a cushion. So that should rates be going up. We also even have a cushion as our A-rated bonds get back to a more normal relationship to the double and triple A's.
Greg, I mentioned you run the ultra short fund, and for a lot of our audience, that doesn't really mean much to them, right? So could you just explain for the benefit of our viewers and listeners what an ultra short fund does and the goal?
Okay, perfect. Um, Most people have a sweep mechanism that goes into a regular money market fund. Yields are non-existent in the money market world. And that's because the Fed is keeping all the very short rates down. The ultra short fund goes out one step further. So we're not bound by the rules for 2A7 funds and things like that. Instead, we can buy a 1-year security. We can buy a 1.5-year security. Money market fund, by definition, has certain limits. So our yield's going to be a little higher, but it's also going to be very stable. We have a $10 NAV, and in the absolute worst, last March, when everything went wrong, we went to 9.99, and we're at 10.02 now. So it's stable, and it gives more income than what a regular money market fund would do. So that's the benefit of it. You get a little extra oomph for your money. And that's basically the nature of the muni market, and that's what people want to do.
Greg, just switching gears a little bit. So I think from the tone in our voice, we're all pretty big fans of this sector, but there are municipalities in general and muni bonds we should avoid, right?
Yeah, part of the problem is that in the muni space, at times people reach for yield. And instead of staying investment grade, which is BAA, triple B or better, they'll go into that double B. Some of them are going to work out, but that's where you have the biggest risks. So what we do for our individually managed clients, we use A as the floor. The idea being, if you have an A-rated bond that goes to triple B, the world doesn't end, but it gives us a chance to take a look and see what's happening. And do we keep it or do we sell it? It's defense. It's still investment grade. You know, just a little further out from you guys is Suffolk County. That's now a triple B rated credit by S&P. It's not going to disappear. It's not going to go away. And, you know, the rumblings of trying to make 2 counties out of it and make it the Peconic County, that's not going to happen. Suffolk County will continue. So for those clients who we might have already owned some, we're just going to hold on. It's only got 6 more months to go before they mature. So again, we're very optimistic in general on the muni space, especially when you diversify, especially when you try and control what you've got. Revenue bonds, some of them are really great. What are revenue bonds? People are going to continue to pay for that. This is only a couple of bucks a month, but it adds up. So we're very, you know, sorry to sound so optimistic and cheerleading, but this is what I've been doing for years and I love it.
But Greg, this is the value of having somebody like you in the picture, right? You're looking at these bonds on an individual bond level. You're
Mhm.
looking at the credit quality. You're looking at the revenue stream, and you're making a judgment call literally daily, right? Is this something
Yeah.
we want to hold on behalf of our clients, or maybe, you know what, cut our losses, get out, and try to anticipate downside and get out?
That's the fun of my job. You know, to me, munis are the close second to treasuries. You know, we were talking about James Lebenthal. He always said, we're the second best investment. And I believe that. It allows people to keep up with their life needs. You can own some bonds. You can set aside, you've got a specific maturity. You know when it's going to come due. And so if you're planning for the college education for the children or things like that, perfect vehicle. And it's there. It allows principal return with high degree of certainty. You know you're going to get your money back. And that's important. Meantime, you're earning some interest.
You know you're going to get your money back when you have an expert like you who's vetting the bond and making sure that they're not buying a credit that, you know, is potentially going to go bankrupt.
Exactly.
And Greg, I know we're running out of time, but we've seen that, right? We saw what happened in Puerto Rico and those bonds. There is always a danger out there, right? So
Oh, sure.
you do have to pay attention. A bond isn't just a bond, right?
That's what I love about my job. That's what keeps it interesting. You know,
Well, thank you, Greg. We appreciate you coming on this evening. Stay
Thrilled
safe.
that it's your job. Thank you.
Thank you. Bye-bye.
Have a great night.
Have a
Thank
great
you.
night. Thank you for
You too.
joining us, Greg.